Can the Aviva Signature Investment Plan Limited Pay let your hard-earned money work as smartly as you do? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So this is a unit-linked individual insurance plan, and some of the key features of this policy are you get flexible payment options like limited premium payment term for added convenience, and you have zero premium allocation charges, so you can enjoy full allocation of your premiums to investment. There are 8 fund options to tailor to your risk appetite for you to choose from, and also there are 2 saving strategies to adjust your portfolio between equity and debt based on your preference and life stage. You can also get up to 100% of the mortality and policy administration charges refunded depending on your premium size, and you have access to funds easily through partial withdrawal and systematic partial withdrawal during unforeseen circumstances. So these are some of the key features of this policy. Now let us take a look at the benefits available under this policy. First is death benefit. So in case of unfortunate event of death of the policyholder, the nominee or the legal heir will get death benefit. So out of these three options presented on the screen, whichever is highest in value at the date of death, that will be given as a death benefit. And additionally, if you had a top-up fund as a policyholder, then these 3 options like top-up sum assured, fund value pertaining to your top-up premiums, like this, out of these 3 options, whichever is highest in value at the date of death, that will also be given as death benefit additionally to the standard death benefit. And next up is the maturity benefit, which will be given to the policyholder once the policy matures. So the following amount presented on the screen will be payable as a maturity benefit. So these are the benefits available under this plan. Now let us take a look at the fund options available on this policy. So they are balance fund 2, bond fund 2, enhancer fund 2, growth fund 2, infrastructure fund, protector fund 2, PSU fund, mid-cap fund, discontinued policy fund. So all these fund options are categorized based on the percentage of allocation they are given to the asset classes like equity, debt, money market and other cash instruments, and also according to the risk profile they possess, which can range from low to medium to high. Now let's move on to understanding the various charges present under this policy. So as I have mentioned before, there are no premium allocation charge, but there is a policy administration charge which will be made by monthly redemption of units from the policy unit account and is applicable throughout the policy term. And there is also fund management charge, which is 1.35% per annum for all funds other than discontinued policy fund. For discontinued policy fund, it would be 0.50% per annum. And they also provide you with mortality charge based on providing you with life cover. So it will be applied on the sum at risk, which is the difference between the amount of death benefit payable minus the fund value as on deduction of this charge. There is also surrender or discontinuance charge. So this charge will be deducted from the policy unit account in case the policy is discontinued within the first 5 years. So it is based on the annualized premium, fund value and the year of discontinuance. But there are no switching, partial or miscellaneous charges. So unlike many other market linked investment option, this plan imposes certain charges that continue throughout the policy term. So these recurring expenses increase the overall cost for the investor and can significantly reduce the potential returns over time. Now, let us take a look at the advantages and disadvantages of investing in this policy. So, the advantages are you have the flexibility to add top up. So, your top up premiums can be added anytime during the policy term and only after completing 5 policy years or upon the policyholder reaching 18 years of age, whichever is later, your partial withdrawals are accessible. And also, systematic withdrawal offer regular structured payouts that align with your financial needs, and because of premium redirection, you are able to reallocate your future premium across funds at no extra cost, and you can also adjust your investments anytime with unlimited free fund switches to suit your changing financial goals. So these are some of the advantages. Now let us take a look at the disadvantage. So the sum assured may fall short of meeting your substantial financial goals, and your investments are made only after deducting applicable charges from the premium, which reduces the investable amount. And also, while mortality and policy administration charges are refunded at maturity, the impact of the time value of money is not accounted for. So these are some of the drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let us now evaluate the potential returns from this policy by calculating an analysis on the IRR based on the benefit illustration provided in the policy brochure. So we can get a clear idea of what kind of returns we will get at the end of the day to help us make an informed decision. So let us now assume that a 35-year-old male opting for this plan with a sum assured of 12 lakhs, the policy term and the premium payment term both are set at 20 years. So with an annual premium of 1,20,000, at the end of the term the accumulated fund value will be paid out. So we have calculated the maturity benefit based on two assumed rate of return like 4% and 8% to indicate the worst and best case scenario. These returns are neither guaranteed nor indicative of the maximum or minimum returns possible under this policy. This is taken just to give you an idea of the worst and best case scenario. So at 4% worst case scenario, your estimated fund value is 30 lakhs, resulting in an at 4% return, which is the worst case scenario, the estimated fund value is 30 lakhs, resulting in an IRR of 2.08% as per the policy's maturity calculator. At 8% return, which is the best case scenario, the estimated fund value is 46.83 lakhs, yielding an IRR of 6.01% as per the maturity calculator. So despite the 20-year policy term, the returns may not align with the requirements of a long-term investment strategy. Given the impact of inflation on financial goals, the returns from this policy may not keep pace, potentially leaving a shortfall in achieving the desired corpus. So this highlights the limitation of relying solely on this ULIP for long-term financial planning. So given the disproportionate risk and return in the earlier scenario, exploring alternative investment strategy can yield better risk-adjusted return. While ULIPs combine insurance and investment, separating these components often proves more effective. So let us analyze two alternative approaches using the same parameter. For life coverage, a pure term insurance policy with a sum assured of 12 lakh costs 6,600 rupees annually for a 20-year policy term compared to the total premium of 1,20,000. In the previous example, this leaves us with 1,13,400 rupees available for investment. So investment options can vary depending on risk appetite. For risk-averse investors, debt instruments like PPF, Public Provident Fund, and for risk-tolerant investors, equity-based investments like ELSS, Equity-Linked Savings Scheme funds can help. So now, estimated maturity value of your PPF investment would be 50.33 lakhs, which will give you an IRR of 6.62%. This return is comparable to the 8% scenario of the Aviva policy. So despite being a debt option, PPF offers superior returns relative to the ULIP. Now your estimated pre-tax maturity value of ELSS investment would be 91.51 lakhs, and your net maturity value after capital gains tax would be 83.06 lakhs. So your post-tax IRR would be 10.76%. In this case, ELSS demonstrates significantly higher returns even after accounting for taxes. So this analysis underscores the advantage of separating insurance and investment. By doing so, investors can achieve higher returns, enabling greater wealth accumulation and faster financial growth compared to the Aviva policy. Now what is the final verdict on Aviva Signature Investment Plan Limited Play? Is this worth investing or not? So this policy combines life insurance with market linked investment but falls short on multiple fronts. So high charges significantly reduce the investable amount and impacting the overall returns from this policy. Our analysis also indicates that the plan's long-term returns are relatively low and fail to justify the risk associated with a market-linked product. Additionally, the sum assured under this plan may not sufficiently cover a family's basic financial needs, potentially jeopardizing the long-term financial security, and it also has a high agent commission. Consequently, this policy is suboptimal for both life insurance coverage and wealth accumulation. So for life insurance, a pure term insurance policy is a more efficient choice, offering robust financial protection for your family at a lower cost. To achieve financial goals, it is crucial to build a diversified investment portfolio spanning various asset classes. So this approach helps mitigate risk, adapt to market conditions, and grow your wealth effectively.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.